There is a voice from history that modern markets would rather forget. Not because it was wrong, but because it was right. A single voice, nearly a century old, that spoke up when optimism was at its loudest. When fortunes were being made overnight. When risk was dismissed as an outdated concept. When the idea of collapse felt almost offensive. That voice belonged to Roger Babson. In 1929, Wall Street believed it had solved the problem of economic cycles. Stocks were rising. Confidence was absolute. Experts spoke of a new era. A permanent era. An era where prices no longer fell. And then one man said something no one wanted to hear. He looked at the same data everyone else was celebrating, and saw disaster. Babson didn't rely on fear. He didn't rely on emotion. He relied on numbers. And what the numbers showed him was simple, terrifying, and unavoidable. The system was fragile. Dangerously fragile. At the time the warning was mocked. Newspapers called it irresponsible. Analysts dismissed it as pessimism. Investors laughed, right up until the moment they didn't. Because months later the U.S. stock market collapsed. And with it, an entire generation of wealth. History remembers the crash. Few remember the warning. That silence wasn't accidental. Because remembering Babson forces us to confront an uncomfortable truth. Markets don't collapse randomly. They collapse when very specific conditions align. Conditions that repeat. Again. And again. And again. And here's the part that should make you uneasy. Those same conditions are not approaching. They are not forming. They are already here. Right now. The same pattern that flashed red in 1929 is flashing again across today's financial system. Not similar. Not approximate. Identical in structure. But far larger in scale. More leverage. More speculation. More speed. More complexity. And just like before, almost no one wants to talk about it. Wall Street strategists remain optimistic. Forecasts point higher. Risk is acknowledged, and then ignored. Confidence is universal. Which is exactly what makes this moment so dangerous. Because when everyone agrees, when dissent disappears, when caution is ridiculed, the system becomes brittle. It doesn't bend. It snaps. This story isn't about predicting the exact day a crash will happen. That's not how history works. This is about understanding why crashes become inevitable. Why they are already built into the system long before the headlines appear. Why the trigger never matters as much as the structure underneath. In the next part, we'll go back to 1929, to the moment when the warning was delivered, to what Roger Babson actually saw, and why almost everyone else missed it. Because once you understand that, you'll never look at today's markets the same way again. To understand why this matters today, we need to return to a very specific moment in history. September 1929. America was convinced it had entered a golden age. The Dow Jones Industrial Average had just reached an all-time high. New millionaires were being created every week. Stocks were no longer seen as investments, they were seen as destiny. Economists spoke with certainty. Bankers spoke with confidence. Politicians spoke with pride. One of the most respected voices of that era declared that stock prices had reached what he called a permanently high plateau. Permanent. No more cycles. No more crashes. No more fear. That belief wasn't fringe. It was consensus. And consensus is powerful. Especially when it feels scientific. On September 5, 1929, at a packed national business conference in Massachusetts, Roger Babson stood before an audience of executives, investors, and industrial leaders. Everyone in that room expected reassurance. They expected confirmation that prosperity would continue. They expected optimism. What they got instead was silence. Then discomfort. Then disbelief. Babson told them a crash was coming. Not a minor correction. Not a temporary pullback. A serious collapse. He warned that stock prices would fall sharply. That the system was overstretched, overconfident, and dangerously leveraged. The reaction was immediate. Gasp. Laughter. Anger. Some accused him of trying to scare the market. Others claimed he didn't understand the new economy. Newspapers later blamed him for causing panic when markets dipped shortly after his speech. They even gave it a name. The Babson break. It was meant as an insult. At the time it seemed justified. The market recovered briefly. Optimism returned. Babson looked wrong. But he wasn't. What followed was not just a crash. It was a collapse so severe it erased nearly 90% of the market's value. Fortunes vanished. Banks failed. Businesses closed. Lives were destroyed. And suddenly Babson's warning no longer sounded extreme. It sounded obvious. So why didn't anyone listen? Because Babson wasn't predicting a headline. He was diagnosing a system. He understood something most investors didn't want to accept. Markets don't fail because of bad news. They fail because of bad structure. By 1929, the structure was already broken. Borrowed money flooded the market. Speculation replaced analysis. And the belief in endless growth eliminated caution. When prices finally began to fall, the system had no shock absorbers. Only accelerators. Forced selling triggered more forced selling. Margin calls created panic. Panic destroyed confidence. And confidence, once lost, collapsed everything built on top of it. Looking back, the signs are impossible to miss. Looking forward, they're harder to see, especially when you're living inside them. In the next part, we'll break down exactly what Babson identified. The 3 signals that made the 1929 crash mathematically inevitable. Because those signals weren't unique to that era. They were a formula. And that formula is active again today. Roger Babson didn't predict a crash by instinct. He didn't rely on fear. He didn't rely on intuition. He relied on structure. What he understood, long before the collapse, was that markets don't break all at once. They weaken first. Quietly. Mathematically. Systemically. Babson identified 3 conditions that, when present at the same time, make a major market collapse not just possible, but inevitable. Not 1. Not 2. All 3. Remove even one and the system can survive. Allow all 3 to coexist and collapse becomes a matter of timing. The first was leverage. By the late 1920s, borrowing had become the engine of speculation. Hundreds of thousands of investors were buying stocks on margin. They controlled large positions with very little of their own money. A small decline didn't just reduce gains. It wiped investors out completely. Babson understood something critical. Leverage turns normal volatility into forced liquidation. When prices fall, investors don't choose to sell. They are forced to sell. Margin calls don't care about conviction. They don't care about long-term belief. They don't care about fundamentals. They demand cash. And when enough people are forced to sell at the same time, prices don't fall gradually. They cascade. The second signal was speculation disconnected from reality. By 1929, stock prices had lost their relationship to earnings. Companies with modest profits were valued as if they would dominate the economy forever. New issues flooded the market, many with little substance behind them. Investors weren't buying businesses. They were buying narratives. The belief wasn't that companies were strong. The belief was that prices would always go higher. And that belief replaced analysis. Speculation becomes most dangerous when it feels rational. When everyone can justify valuations. When new metrics are invented to explain why old rules no longer apply. Babson saw that clearly. He knew that when prices detach from reality, they don't gently reconnect. They snap back. The third signal was the most dangerous of all. Consensus. By the end of the 1920s, there were no skeptics left. Every major voice agreed. Every respected expert was bullish. Every institution reinforced the same message. The future was secure. Growth was permanent. Risk was obsolete. Babson called this the final warning sign. Because when everyone agrees, no one prepares for alternatives. No one hedges. No one plans for failure. No one asks what happens if expectations aren't met. The system becomes optimized for one outcome, and completely defenseless against every other. Consensus creates fragility. And fragility doesn't reveal itself in good times. It reveals itself under pressure. These 3 forces, leverage, speculation, and consensus, don't just coexist. They amplify each other. Leverage magnifies speculation. Speculation feeds consensus. Consensus encourages more leverage. It's a closed loop. And once that loop is complete, the system no longer needs bad news to fail. It only needs doubt. Babson didn't know the day the market would collapse. But he didn't need to. Because once all 3 signals were present, the outcome was already embedded. The crash was no longer a question of if, only when. And that brings us to the present. Because those 3 signals didn't disappear with the Great Depression. They didn't vanish after 2000. They didn't vanish after 2008. They returned. And today they exist at a scale Babson could never have imagined. In the next part, we'll look at how those same 3 forces are operating right now, inside today's markets. And why this time, the consequences may be even more severe. Everything Roger Babson warned about in 1929 exists again today. Not in theory. Not in fragments. In full alignment. The first signal, leverage, has returned in a form far more extreme than anything seen a century ago. Today's market isn't just leveraged through margin accounts. It's leveraged everywhere. Margin debt has surged to record levels. Corporations are carrying historic amounts of debt. Governments are drowning in obligations accumulated over decades of cheap money. But modern leverage doesn't stop there. Derivatives quietly multiply exposure beneath the surface. A single dollar of capital can control dozens, sometimes hundreds, of dollars in risk. This means small moves no longer stay small. They propagate. What once took months to unravel now happens in days, sometimes hours. The second signal, speculation disconnected from fundamentals, has returned with a new narrative: artificial intelligence. Today, companies with minimal revenue command enormous valuations simply by attaching two letters to their story. Just like radio in the 1920s. Just like the internet in the late 1990s. A transformative technology. Unlimited potential. And expectations so high that reality has no room to breathe. Markets are no longer pricing what companies are earning. They're pricing what investors hope will happen years from now. Tomorrow's success. At today's prices. That's not investing. That's faith. And faith becomes fragile when results fall short. The third signal, consensus, may be the strongest of all. Nearly every major institution expects markets to rise. Strategists acknowledge risks, inflation, debt, geopolitics, and then dismiss them in the same breath. The average forecast still points upward. This is where the warning becomes loud. Because consensus doesn't fail gradually. It fails all at once. When expectations shift, there is no middle ground. Positions are crowded. Trades are one-sided. Everyone is leaning the same way. And when they rush for the exit, there isn't enough liquidity for all of them. Modern markets have added something Babson never faced: speed. Algorithms react faster than humans can think. Passive funds sell automatically. Risk models reinforce each other. What begins as a correction can turn into a cascade before anyone understands what's happening. And hovering over all of this is policy. The central bank that once stabilized markets now faces its own credibility crisis. The Federal Reserve is trapped between inflation and instability, between supporting asset prices and preserving trust. Every decision carries consequences. Every pause creates uncertainty. Markets don't fear bad news as much as they fear confusion. And confusion spreads quickly. Banks sit at the center of this web. Regional institutions are heavily exposed to commercial real estate. Office buildings stand half empty. Loans written under one reality are maturing in another. Higher rates, lower occupancy, falling values. The math doesn't work anymore. And when the math stops working, confidence follows. Defaults don't need to be universal to be dangerous. They only need to be contagious. All three signals are active: leverage, speculation, consensus. Individually they're manageable. Together they are explosive. This doesn't mean collapse happens tomorrow. It means the system is primed, waiting. In the next part, we'll talk about the moment everyone misunderstands: the trigger. Why crashes aren't caused by one event, and why focusing on the trigger blinds people to the real danger. Because by the time the trigger arrives, it's already too late. This is where most people get it wrong. They search for the event, the headline, the moment everything breaks. A missed earnings report, a bank failure, a geopolitical shock, a policy mistake. But history tells a very different story. Crashes are never caused by the trigger. The trigger only reveals what was already broken. By the time markets react violently, the damage is already embedded deep inside the system. Think back to every major collapse. In 1929, it wasn't a single bad day that destroyed the market. It was years of leverage unwinding all at once. In 2000, it wasn't the failure of one internet company. It was the realization that expectations had outrun reality. In 2008, it wasn't one mortgage default. It was an entire structure built on assumptions that could not survive stress. The trigger didn't create the collapse. It exposed it. That's what makes today's environment so dangerous. Because the system is once again optimized for perfection. Asset prices assume continued growth. Debt assumes stable refinancing. Valuations assume flawless execution. There is no margin for disappointment. And when disappointment arrives, it doesn't need to be dramatic. It only needs to be enough. Enough to create doubt. Enough to tighten liquidity. Enough to force the first seller. From there, the mechanics take over. Margin calls demand capital. Funds reduce exposure. Banks pull back lending. Selling leads to lower prices. Lower prices trigger more selling. This is how corrections become crashes. Modern markets amplify this process. Passive investment vehicles don't analyze. They rebalance. Algorithms don't hesitate. They execute. Derivatives don't negotiate. They settle. When liquidity evaporates, everyone discovers at the same time that exits are narrower than entrances. And once confidence breaks, it doesn't return on command. Central banks can inject liquidity, but they cannot instantly restore trust. That's the part models fail to capture. Trust is psychological, fragile, nonlinear. It disappears far faster than it's built. Recent history already gave us a warning. A single regional bank unraveled in days. Not because of fraud, not because of recession, but because rising rates exposed risks everyone assumed were manageable. Depositors moved money with a swipe. Markets reacted before regulators could respond. That wasn't a systemic crisis. It was a preview. Now imagine the same mechanics, playing out across multiple sectors simultaneously. Commercial real estate, regional banks, overleveraged funds, crowded equity trades. No single event needs to be catastrophic. They only need to overlap. And when they do, the system doesn't bend. It fractures. This is why focusing on what will cause the crash misses the point entirely. The real question is simpler and far more uncomfortable. Is the system resilient enough to absorb shock? History suggests that when leverage is high, speculation is widespread, and consensus is absolute. The answer is no. In the final part, we'll bring everything together. Why this moment rhymes so closely with the past. Why the window ahead matters. And why understanding this pattern isn't about fear. It's about awareness. Because once the signal is complete, the only remaining variable is who is prepared. There's a phrase often repeated in finance. History doesn't repeat itself, but it rhymes. Most people hear it as poetry. Few understand it as a warning. Because when the rhyme becomes this clear, this precise, this mathematically familiar, it's no longer coincidence. What Roger Babson identified nearly a century ago was not a market event, was a pattern. A structure that forms when confidence replaces caution, when leverage replaces restraint, when consensus replaces thinking. That structure collapsed in 1929. It resurfaced in 2000. It reappeared in 2008. And today it stands once again. Larger, faster, and more interconnected than ever before. This doesn't mean the future is written line by line, but it does mean the range of outcomes is narrowing. When leverage reaches extremes, when speculation becomes cultural, when everyone believes the same story, the system loses its flexibility. It can no longer absorb surprise. It can only react violently. This is why the most dangerous moments in markets don't feel dangerous at all. They feel calm, optimistic, confident. They feel like now. The greatest risk is not that something unexpected will happen. The greatest risk is that expectations will be disappointed, even slightly. Because in a fragile system, slight disappointment is enough. This isn't about panic. It isn't about predicting dates or headlines. It's about understanding structure. About recognizing when stability is assumed rather than earned. When safety is priced in instead of built in. Babson understood that long before modern finance existed. And the system punished those who ignored him. The question today is not whether history will repeat perfectly. It won't. The question is whether we recognize the rhyme before it finishes the verse. Because when crashes arrive, they don't announce themselves. They don't wait for consensus to shift. They don't offer second chances. They move with speed, with precision, and with consequences that last far longer than the optimism that preceded them. If you've stayed until this point, you're not here for noise. You're here to understand how the system really works. This channel exists for exactly that reason. At Finance Archives, we study the patterns others forget, the warnings others dismiss, the history that quietly explains the present. If you want to see the signals before they become headlines, if you want context instead of chaos, and clarity instead of comfort, subscribe to Finance Archives. Because markets reward awareness long before they reward optimism. And the most important lessons in finance are almost always buried in the past.